You probably think inflation happens because governments print more money. That's not entirely wrong, but it's dangerously incomplete. So by the end of this video, you'll understand what inflation actually is, what sets it off, and why slowing inflation can never actually hand back the purchasing power we've already lost. You'll also know exactly how it reaches your savings, your salary, your debt, and your investments differently depending on the cause. I'm DC Roth from the Bureau. We've educated more than 3 million people on money and markets here on YouTube, and hopefully this will become the only explanation of inflation you'll ever need. Okay, so what actually are the causes? Inflation can explode because oil gets scarce, supply chains break, demand comes roaring back, or people start expecting every price to be higher next year. And which one of those is actually driving it changes everything about what happens next. It also explains one of the most annoying questions in economics: if inflation is falling, why is it that nothing is ever getting any cheaper? Now, of course, money printing is part of the story, sometimes even a very important part. But if that's the only lens you'll ever use, you will misread the economy, misread the policy, and misread your own financial position on top of it. So let's test the argument you've probably already got in your head. As you know, central banks run quantitative easing, money printing, a fancy term that basically means buying bonds to push new money into the banking system. The assumption is that more money automatically means higher prices. And there's an entire economic school built around this idea, the Austrian school. Ludwig von Mises and Friedrich Hayek. They say inflation is fundamentally a monetary phenomenon. Distort the money supply and the credit on top of it, and you distort prices with boom-bust cycles following close behind. Across from them sits the Keynesian school, and in this view, the bigger lever is demand. How much people and governments are actually spending, and policy should manage that demand directly. Now, Austrian versus Keynesian has been the same fight for a century now. Keep both of those in your mind, because this video is going to test each one against real events, and by the end, neither one walks away completely clean. Milton Friedman, one of the most influential economists of the 20th century, put it like this: inflation is always and everywhere a monetary phenomenon. Over long stretches, money growing faster than the economy can produce is hard to separate from higher prices. But always and everywhere is doing a lot of hiding in that sentence. For prices to rise broadly and stay up, spending power has to run into the amount of real stuff the economy can actually provide. So money matters. How fast it gets spent matters as well, and how much the economy can produce matters just as much. So when a bank makes a loan, it creates a new deposit, but that borrower still has to spend it. The person who receives it can save it, pay off debt, or spend it again. Every choice changes how much of that money actually reaches real goods and services. That spending speed has a name which is incredibly important: velocity, the velocity of money. When people feel nervous, they hold bigger cash buffers and money moves slower. When they feel confident, the same amount of money can race through the entire economy. Just picture this: everyone wakes up tomorrow with twice as much money. In a stressful environment, people are worried, so they save most of it. Businesses may invest a little here and there, production rises a tiny bit, and a lot of the extra money just sits there doing absolutely nothing, meaning prices barely move. Now, if we assume the opposite, people are happy and the economy is booming, they spend immediately. Factories are already flat out, workers are scarce, more spending chases roughly the same pile of goods, so businesses raise prices and workers demand higher pay. With the same extra money, we now have two completely different outcomes. So assuming that inflation happens just because more money is being printed is not accurate and actually quite misleading. Central banks can push on borrowing costs and demand, but it's indirect and it takes time because velocity and real supply keep shifting underneath them. Now, you might be wondering, if more money sitting in accounts isn't the automatic trigger, what actually pushes prices to go up? Usually an imbalance. Too much spending chasing too little supply. Or the nastier version, demand doesn't rise at all, supply simply shrinks. Which raises the real question: when does one price rising actually spread into inflation across your whole life? And when is it just one price being annoying? Inflation is a general increase in the overall price level of goods and services over time. It also reduces your purchasing power continuously. So if a dozen eggs cost more because a bird flu wiped out millions of chickens, that's a relative price change. Painful if you go through eggs like they're going out of style, but one price moving does not automatically mean inflation. Egg prices in the US shot past $6 a dozen, then fell by more than half within about a year once flocks recovered. If eggs can swing that hard while televisions, haircuts, rent and electricity barely moves, purchasing power has not changed in the same broad way. Inflation starts when price rises spread widely across everything you buy. One price can kick that off, especially if it's an input used everywhere. This is also where the public conversation usually falls apart. The price level is the total height of prices. Inflation is the speed at which that height is climbing. So picture a price index sitting at 100. 1 year it climbs to 109. That's 9% inflation. The next year inflation falls to 2%. The index does not drop back to 100. It climbs from 109 to about 111. Prices are still higher than they were and higher than last year. They're simply climbing more slowly. That slowdown is called disinflation. Inflation is still positive, the rate has just come down. Deflation is a broad fall in the price level itself. So when someone tells you inflation has fallen, they're not telling you your supermarket bill is about to reverse. They're basically telling you that the rate of increase has eased. In other words, the surge has stopped accelerating, but everything it already added stays baked into the price you're already paying. To actually get your purchasing power back, prices would need to fall, or your income would have to catch up and overtake them. But this brings us to an issue because broad deflation squeezes wages and makes steps heavier in real terms. So policymakers never aim to unwind every past price rise. They aim to stop it from climbing any further. That's why inflation is coming down can feel like your receipts are being gaslit. The number is correct, your bill is also correct. You're looking at two different things: the rate of change against the level that's already been reached. Now remember, one price can kick off something much bigger if it's an input used everywhere. There's exactly one commodity that fits this description perfectly, and it happens to be blowing up in the headlines again as you're watching this: oil. Right now in 2026, this is not just a textbook example, it's everywhere in the news. A war between Israel and Iran escalated into direct military conflict involving the United States. Attacks on energy infrastructure and shipping in the Strait of Hormuz, the route that carries roughly a fifth of the world's oil and a large share of seaborne crude, triggered the largest oil supply shock on record. So Brent crude ran more than 50% above where it started the year at its peak. The World Bank even expects oil to average around $86 a barrel across 2026. That's up from $69 the year before. That's your gas station, and depending on where you live, quite possibly your heating bill too. Here's why one commodity can do that much damage. Oil and gas don't just matter when you fill up the car. Energy moves things, heats things, cools things, and manufactures almost everything else you own. A spike doesn't stay where it starts. It's just the first domino, and everything else you buy is standing right behind it. Ships burn fuel, so transport costs rise. Natural gas is an input in fertilizer, so farms, processing plants, and delivery trucks all get more expensive at the same time. Factories pay more for electricity, for plastics, chemicals, and transport all at once. Firms with strong demand raise prices. Firms with weak demand eat the loss or delay hiring. And what we're seeing today was not the first time. 1973, 1979, 2022, and now 2026. Different decades, different conflicts, but the same mechanism every single time. Now, luckily for us, not every oil spike becomes lasting inflation. If supply recovers, firms absorb part of the hit, demand weakens, and people don't panic about the future, the effect can fade. A one-off jump even stops adding to the annual inflation number once it rolls out of the year-on-year comparison, even though the higher price itself remains. The problem is what happens next to our own psychology inside people's heads. If workers expect the shock to keep eating their pay, they push for higher wages. If firms expect their costs to stay high, they build that into prices and contracts. If households rush to buy things before prices rise further, demand stays hot even while supply is already struggling, meaning the original shock, an event nobody in the economy actually controls, has now changed how everyone behaves. That's how a temporary problem turns into a permanent one. So if we push the Austrian view too far, we get inflation is always and everywhere a monetary event, full stop. If we push the Keynesian view too far, we get the money supply barely matters, it's all demand and confidence. A war closing a shipping lane just proved both of those absolutist versions wrong at the same time. Nobody printed a single extra dollar to trigger this shock, and yet prices moved anyway. But how far it moved also depended entirely on demand, confidence, and expectations. Now you might be wondering, if a war can do this to prices, hasn't anyone ever tried to build a system where it simply couldn't happen? Yes, in fact, people have actually tried twice. After the Second World War, the Bretton Woods system linked currencies to the US dollar, and foreign governments could convert dollars into US gold at $35 an ounce. As American spending kept adding dollars to the world while the gold pile stayed roughly fixed, some governments started doubting whether every dollar could really be converted if they all showed up at once. So on August 15, 1971, President Nixon suspended that conversion, closed the gold window, and rolled out wage and price controls in the same announcement. Gold limited what governments could get away with, but it didn't eliminate inflation, credit booms, or the price spikes that come with war. Governments could still redefine what an ounce of gold was worth, break the promise to convert it all, or just let banks lend out more money than the gold in the vault could ever possibly cover. Gold simply changed the rules of the game, but it didn't turn the game off, so to speak. The thing is, that decade didn't have one cause, it had at least four, all running simultaneously. Loose monetary policy, years of heavy government spending, Bretton Woods collapsing, and the 1973 and 1979 oil shocks landing right in the middle of it. If we stack all four together, with the public increasingly convinced high prices were never coming back down, you get the great inflation of the 1970s. Today, economists still argue about how much each one actually mattered, but nobody honest blames the whole decade on one president, one embargo, or one simple line on a chart. The Keynesian framework had assumed inflation and unemployment traded off against each other. The 1970s broke that completely, stagflation, and the standard toolkit didn't have a clean answer. That failure is a big part of why the monetary side of the argument got taken more seriously again. But the pure Austrian prescription has its own weak spot. Let the bus run its course with no bailout and no stimulus. When that approach has been tried at scale, it has coincided with some of the most painful downturns on record. Being right about the disease doesn't mean you're going to be right about the cure. And this brings us to Bitcoin, which is today's attempt at exactly that cure. A fixed supply that no government can print more of. On paper, it should track money printing almost perfectly. In theory, it should be the cure for inflation, except it isn't. The biggest stimulus era in decades, 2020 into 2021, sent Bitcoin to a record high near $69,000. Then, in 2022, as central banks raised rates to fight the inflation that stimulus helped cause, Bitcoin fell more than 70%. The supply cap never changed for 1 second. What actually moved the price was demand, confidence, and how expensive it suddenly became to borrow money. The same three forces that moved everything else in this video. Gold didn't make runaway prices impossible. Bitcoin hasn't either for exactly the same reason. A fixed supply can protect you from one specific failure model. It cannot protect you from war, a bad decade, or your own government deciding that fighting inflation is worth causing a recession. Which is exactly what one very famous government did next, and it finally answers the question of how you actually stop this once it's already running. In the early 1980s, Paul Volcker pushed interest rates high enough to actually break the inflation that decade had built up. It worked. It also triggered one of the worst recessions in decades. So this wasn't a clean victory lap. It was an expensive bill for a problem that had been allowed to become entrenched. But this also answers why central banks are willing to pay a price that steep. Inflation isn't just about what's happening right now, it's about what people expect to happen next, because that expectation changes their behavior today. This is basically how markets work. So central banks raise interest rates. Okay, let us quickly follow this through with three ordinary decisions. They explain it perfectly. Someone applying for a mortgage sees the monthly payment jump and delays buying. A business facing expensive credit shelves a factory expansion. Or an employer looking at weaker orders just leaves a role unfilled. Now, none of them produced a single barrel of oil or fixed a supply chain, but across millions of decisions, just like theirs, spending, investment, and hiring all cool down at the same time. That's supposed to give supply room to catch up and prove that the high inflation will not simply be tolerated. If people actually believe that, they start setting wages and prices as if inflation is already coming down, which helps make it true. Now, the problem is that bill doesn't land evenly. Someone with a fixed rate mortgage barely feels the rate hike. Someone with a variable rate gets hit twice as hard. First at the shop and the pump from the original price rises, then again when their own monthly payment resets higher because of the exact policy meant to fix it. But does everyone even live through the same inflation number in the first place? Take a renter and a homeowner earning the exact same amount in the same city. The renter drives every day and spends heavily on food, heating and fuel. When the rent renews high and fuel jumps, they feel it within a month. The homeowner bought years ago, works from home, rarely drives, and has far more room to cut back. So the national inflation number is identical for both of them, but their actual lives are not even close. Now here's the twist. Say the homeowner's mortgage is variable. The central bank raises rates to fight inflation, their payment resets higher, and the policy meant to fix the problem is now hurting them on top of the original shock. Same country, same headline number, completely different reality depending on one line in a mortgage contract. Okay, so if everyone's basket and life is different, who actually wins and who loses when the same inflation number hits? Let's picture 5 people living through the exact same number. Not all 5 of them are losing. First, a fixed rate borrower's monthly payment never moves, no matter what the central bank does. If their income rises while that payment stays frozen, they end up repaying the loan with money that's worth less every year. That's an exceptionally good deal for them and a very bad deal for whoever lent them the money. For this one person, inflation is actually working in their favor. This method is precisely the one rich people tend to use and brag about if it works. But not everyone gets that lucky. Someone whose pay only gets reviewed once a year absorbs higher bills for months before any raise even gets discussed. A variable rate borrower actually gets hit twice. You already know this one, first at the shop and the pump from the original price rises, then again when their own monthly payment resets higher because of the exact policy meant to fix it. A cash saver doing everything right by conventional wisdom loses too. If the interest on that account doesn't beat inflation after tax, the number in the account keeps climbing while what it actually buys keeps shrinking. And contrary to belief, an asset owner isn't automatically safe either. Property can gain from rising rents and then get crushed the moment higher rates wreck affordability. Bonds fall when yields rise. Even gold and Bitcoin move on liquidity and risk appetite, just like everything else. So no single asset hedges every version of this. And underneath all 5 sit the households for whom this isn't a portfolio question at all. When necessities eat most of what you earn, there's no fixed rate mortgage or savings account cushioning any of it. Lower income doesn't just mean less money, it means less room to absorb the exact same shock everyone else is living through. Which is precisely why the real payoff here isn't picking a side. It's this: the cause behind the inflation, your own balance sheet, and how the central bank responds all decide what happens to you specifically, which makes this so important to understand. You can actually go check where you stand right now. Just weight your own spending, track the categories that actually dominate your life, like rent or mortgage, fuel, food, energy, and compare that personal rate to the official number. That's the actual number that tells you whether you're on the losing or on the winning side of all of this. Understanding inflation means understanding more than just the fact that prices rise. It means knowing why your purchasing power changes, why a falling inflation doesn't mean falling prices, and why the same number creates completely different winners and losers depending on where you're sitting. So printing money is not the wrong answer, but it's about 20% of the entire answer, and now you have the rest of it. But which explanation did you believe before this video? Was it purely printing, or was it oil, or was it something else entirely? Please let me know in the comments below. And if you want to see exactly where all of this, inflation expectations, interest rate bets, gets priced before it hits any headline, that's what the bond market does every single day, and you can check out our deep dive right over here. Understanding the bond market is also a big part of understanding money. As always, thanks so much for watching, and I'll see you again very soon.